Los Angeles. Jim, great to chat to you as always. Let's talk about what's going on in US equities. We saw a big bounce up today, of course, recovering from at least some of the sell down we saw last week. Was last week an overreaction, or should we get used to a bit more volatility, the likes of which we've seen over the last few days?
Well, Matt, thanks for inviting me. I absolutely think that this was a bit of a bounce back from last week's exaggeration. When I saw the market continue to go up today, I was asking, where were all these buyers last week, right? I mean, nothing has changed with the fundamental backdrop, but somehow people feel better today. I don't know what it is, but I do think that it was a strong reaction and recovery from last week. Stocks up anywhere from 2 to almost 3% today. So we've got a ways to go to make up for the declines last week, but we're certainly well on our way.
Earnings really supporting the market overnight. Do you think that the market had been underestimating the earnings picture coming into this third quarter earnings season? Because we've been hearing a lot in the lead up to the earnings season that companies may disappoint, yet we're seeing the likes of some of the banks overnight. Morgan Stanley up by more than 5% on the back of strong earnings. So do you think that markets have been underestimating the strength, the underlying strength of US corporates?
Matt, I don't know that it's as much that the market's been underestimating earnings as it is that there's a tremendous amount of anxiety out there. Clearly, the market has been on a terror of late, and we saw a very, very rapid recovery from the sell-off in the U.S. market earlier this year. And at one point, as you know, the S&P 500 was up over 11%. And so I would argue that perhaps a bit more than being not quite, or underestimating earnings, I should say. I think it's just that we've got a situation where investors have just gotten a little bit concerned about the market moving too far too fast.
What sectors do you like at the moment in the current environment then?
I'm sorry, what?
Which sectors do you like in the current environment that we're seeing on the market then?
So, Matt, I have to say, one of the things, energy and financials in both the stock and the bond market seem attractive to us. First of all, you've got higher rates. We've had rates move up in the long end, longer-term maturity rates, and that is on balance should help to improve banks' earnings as they earn wider margins. And clearly oil prices have strengthened, and that should be good for continued growing profits and revenue streams with the oil companies. So I would say energy is an attractive area, financials is an attractive area. The other thing is we've seen a very huge sell-off in small cap stocks in this recent sell-off. And I think that that is overdone, and that there is some value in some of the smaller cap stocks that should continue to do well as the fears about tariffs eventually continues.
Okay, what about tech? We've been talking about Netflix earnings after the bell, the stock surging by about 15% after hours. We really saw tech lead the market down when we moved lower, and today supported the market on the way back up. What do you think about the tech space?
I think that the tech space, again, both in stocks and bonds, Matt, is also attractive. These companies just continue to generate significant earnings growth. Couple of examples would be names like a Cisco or a Texas Instruments, where we are seeing double-digit increases in earnings growth, yet their dividend yields are anywhere in the high 2s to low 3%. And they now have, in the case of some of the larger companies that were holding a lot of their cash overseas, some or all of that has been brought back to the United States, and they're doing things like buying back stock, and they're actively looking for acquisitions. And these are all things that I think are very positive catalysts for continued growth in the future.
Jim, we are out of time, but appreciate you joining us this morning. Jim Sarni from Payden and Rygel Investment Management there from Los Angeles this morning. Thanks very much. Well, moving on. And